It's a quiet start, absolutely. Maybe just a few more names before we bring in our next management. Nykaa is a name which you may want to look at. It's down 1.5%. Stock was up 7% yesterday on very strong it was up 7%, has underperformed, lost about 70% from the highs. Yes Bank is down about 1.25%. I pointed out Ambuja Cements. ACC is another one which is down a little bit. And you've got a bunch of these other names which are, there is more down than up at this point in time if you look at the broader screen. Sonia.
Okay, we were just mentioning how SBI Card is under pressure post the disappointing set of numbers. The net interest margins came in at an all-time low for the bank. And over the last few quarters, the revolver rate for SBI Card has also come down to around 24% from the earlier 45%. Rama Mohan Rao Amara, who's the MD and CEO of SBI Card, joins us now. Mr. Amara, the growth has definitely slowed down. The business momentum has been, a bit weak over the last couple of quarters. Just wanted to understand from you, in terms of new accounts, there's still a growth that you're seeing, but what is the kind of trajectory? In this quarter gone by, your new accounts were about 16.5 lakhs and the new cards were at about 1.59 crores. Can you give us some numbers on what the next few quarters could look like?
Good morning, Sonia. As you rightly said, the Q3 new account acquisition has been around 1.6 million, which is a 60% growth as compared to last year, corresponding period. So we are growth focused. For us, all the channels have been delivering, both banker as well as open market. Digital channel has also started contributing in a significant way. But the results of it's more like an investing for future, in the sense a typical new customer takes time to start using the card in a big way. Only over a period of time, you start seeing them spending for big ticket transactions as well as on the discretionary goods. So the results will be coming. The positive impact of this investing in growth will be visible in the next few quarters to come. As far as acquisition is concerned, we have stated a stance of maintaining a net addition of minimum 300,000 per month. Last few months, we have been able to maintain that, and this will be our endeavor, where we would like to maintain a kind of sustainable growth, at least a kind of 1 million net addition per quarter we want to ensure by managing both the card issuance as well as the attrition.
So that is 300,000 per month is for new accounts, is it?
Yes, that's a net addition.
Okay. Net addition. Okay, got that. We've been having this conversation ad nauseum about how the spends per card is slowing down a bit. This time as well, your growth in spends per card is barely, less than 5%, low single digit. Why is that? And what do you see as, is there a sort of changing trend that you're noticing amongst customers? And what do you see as the growth in spends per card for the rest of the fiscal?
Spends per card, the metric which you said and the kind of figures what you alluded to, I think comprises even the corporate card spends as well. If we knock it out or strip out the corporate card spends and only focus on the retail spends per card, we have recorded a 8% year-on-year growth, despite the base growing by 21% during the last 12 months. So that way, through improved engagement efforts, by making right offers to the customers, we are actually able to maintain the momentum and increase in the per card spends. Looking at the retail spends, our retail spends have actually increased by 29%, backed by the kind of festival spends and, of course, the revival in the travel segment in a big way. And in general, there is an improvement in the discretionary spends. So all these things have culminated in a 29% year-on-year growth in the retail spends. While, of course, we have a corporate card spends, they contributed around 10%.
Okay, all right. Hi, Mr. Amara. There are two problems with the numbers. One is the declining revolver contribution, which has come down to around 24%. And the second factor is the cost of funds are likely to go up even from year on after increasing in the past quarter. So give us some bit of a guidance on both those two. How is the mix likely to change? Revolver has come down. Has it bottomed out? Will it increase from year on? Point number one. And the second factor is the cost of fund goes up by how many basis points in quarter 4?
Yeah, revolver is at 24%, which is at the same level as Q2. We have seen our internal analysis does indicate like after the pandemic and after clearing the portfolio from the chronic revolvers, the share of the chronic revolvers, that means who typically revolve more than 6 times in a year, I think that share is slightly declining. But having said that, actually the revolve balance absolute amount, if you look at, actually it is growing. The point is like it is not in tune with the overall linear growth, so that's the reason the revolver share is slightly low. But
Yes.
Otherwise, in terms of new additions, etc., the revolve balances are increasing. But having said that, in as much as the credit costs are well within our internal range, acceptable range, we are experimenting with a new segment. We are increasingly getting younger generation as customers. We are increasingly attracting self-employed who have better propensity to revolve. So we are hopeful, while the pace hasn't been at the desired level, we are still hopeful that a revolve will increase over a period of time. Coming to the cost of funds, we guided in the past as well, given that actually majority of the funding happens through short term, and given the fact that actually asset loans are given on a fixed rate basis, whenever there is increase in the interest rates, you will witness a kind of faster increase in the cost of funds as compared to yield on the loans, putting a pressure on the NIM. So in the past, we guided that the cost of funds will increase, but we have observed most of these repricing, etc. So next quarter, we will be seeing maximum like a 30 to 40 basis point further increase in the cost of funds. But we are confident of absorbing it actually through two measures. One is by constantly focusing on the share of EMI loans, which has steadily been increased quarter on quarter, and also transmitting the rate in the loan disbursals, which will help us in offsetting the cost of funds.
Okay, valid points then. Revolver is not giving so much traction, but your focus is on EMI and you're looking to pass through the higher cost of funds as well, which could go up by around 30 to 40 basis points. What does it mean for the yield? Now, for the past quarter, yield is at around 16.4%, which was maintained on a sequential basis, but your NIMs had come down to around 11.6%. So will NIMs increase from this 11.6% odd? Give us a guidance on that number. And credit cost as well, you said, things are improving out there. So what's the guidance? Wanted numbers on both these two.
As I said, the NIM will fairly stabilize, maybe 10 basis points here and there, that movement can be there. But we are fairly confident that actually NIM will stabilize in the next quarter at the current level.
Okay. Actually, I had a follow-up here as well. I guess the reason why Nigel is asking you is because, in FY21, your net interest margins were at 15.8%. So just trying to understand, when will the NIMs bottom out? And is 15% plus NIMs doable, say, in the next, say, 1 to 2 years?
I alluded to a kind of balance sheet structure where the loans carry a fixed rate of interest, while the funding is majorly through the short term. In a declining interest rate regime or a benign interest rate regime, it helped us actually improving the NIM. But at the same time, in an increasing rate of scenario, this has an adverse impact on the NIM. We are taking different measures. We are operating at a different level. We are looking at cost efficiencies, rationalization wherever is possible. We are investing in the future. So this will actually help us in terms of absorbing whatever the little dips are there in the NIM and some fee lines, and help us maintain a healthy proportion between the interest income and the non-interest income at 50% to 50%. So credit costs, we alluded to credit costs at 5.6%, which is a decline of 60 basis points as compared to last quarter. Ignoring the quarter-to-quarter variances, we are fairly confident of keeping it below 6% over a period of time.
So
Mr. Rao, on earnings then, let's just kind of put all of this together. What kind of earnings growth should we expect? I mean, the street is expecting between 25 and 30% earnings growth for the next couple of years. Is that reasonable?
I think, as I said, the rapid growth, what you see in acquisition will not immediately translate. There will always be a lag effect. And of course, we have a play of interest rates now. So it will be at the current level for a couple of quarters, because we are absorbing a lot of changes that are happening in the ecosystem, be it the interest rates, be the kind of regulatory changes that are happening, etc. For a couple of quarters, the current rate of growth only we will be able to maintain.
Okay, just one question. What would the impact be of this MDR discount removal from the RBI? How big is it for banks, and what would the impact be for you?
If I'm correct, I think it's only a discussion paper released by RBI as of now. So we have shared our feedback along with other industry players, and the RBI is yet to take a call on MDR. So
but if it does come through, then no. But if it does come through, then what would the impact be?
I mean, in the past, several times this aspect was visited, where industry has given the feedback and pleaded a case where why it should be treated differently and why it is unique as compared to debit card in terms of offering so many benefits to the customer and then footing the credit cost. This aspect was considered, and that's the reason it was not touched. We don't know, like, if at all, if it is revisited, to what extent the MDR will be impacted. If it is a small kind of impact, then obviously it can be taken in our stride. If it is a larger one, obviously we need to look at what cost we can rationalize.
Okay, all right. Very quickly, sir, your cost to income ratio, that's moved up to around 62%. Does it normalize at lower levels from here on?
Normally, Q3, which is marked by the festive period where the cashback offers are also made on a larger scale, normally we see this is the seasonality. This is the trend what we see. At a elevated cost to income will be there for Q3, and it gets normalized in Q4. So we are confident of keeping the cost to income below 60% in Q4.
Okay.
All right. We'll leave it there. Thank you very much, Mr. Rao. Appreciate you joining in, and good luck. Maybe a better quarters the next few. But rates are rising, and as the SBI Cards management said, cost of funds will go up. NIMs maybe here, 10 basis points here or there. That's key. 90 points lower, by the way, than markets at the day's low. The Nifty will come up, the Nifty intraday will come up on your screens. And, overall market breadth is also looking worse off. I mean, 1250 stocks are lower, 700 stocks are higher. We'll come back with Girish Kausgi of PNB Housing Finance to talk about the third quarter earnings. And later, we'll have the management of Sona BLW to discuss their acquisition of 54% stake in Serbian company Novelic. Stay tuned.